gold has performed exactly as it should do into a black swan event. And as we assessed last time, initially the gold price overshoot was caused by the plunge protection team disruptively leaning into the plain vanilla mechanical sell-off, which in turn was what generated this myopic mainstream media, their failed safe haven narrative. And whereas in the global picture, it was the West's focus on derivative gold that has actually been effectively challenged. Now, under the covers, global South nations stepped up converting overpriced dollars into underpriced physical gold.
Unlike previous price spikes driven by single catalysts, the current surge reflects a convergence of unprecedented factors. Central banks worldwide have accelerated gold purchases to historic levels, with emerging economies leading the charge. Simultaneously, persistent geopolitical tensions across multiple regions have created sustained safe haven demand that shows no signs of abating. The dynamics driving why gold price is increasing in 2026 differ fundamentally from earlier rallies. Traditional inverse correlations with interest rates have weakened as gold continues climbing even as monetary policies stabilize. This suggests deeper structural shifts in how investors and institutions view gold's role in portfolios. Global financial expert AndrewMaguire emphasizes that prolonged war-driven volatility has distorted gold and silver markets. While the paper-driven COMEX suggests weakness, the Shanghai Gold Exchange reflects strong physical demand. He mentions that central banks are using this gap to shift out of U.S. dollars and treasuries into gold and silver. He adds that dollar-driven selling in derivative markets artificially pressured gold lower, but this paper-to-physical disconnect has built up pressure for a sharp rally, potentially pushing gold beyond previous highs. Based on fundamentals, Maguire also criticizes mainstream narratives that claim gold has lost its safe haven status. In his analysis, AndrewMaguire goes on to say that what appeared to be weakness was partly due to mechanical selling and interventions, referencing actions often associated with institutions like the Bank for International Settlements. Despite this, physical buyers, especially from Global South nations, have been steadily accumulating gold, effectively establishing a higher price floor. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from AndrewMaguire's recent interview.
One full month of relentless, unprecedented war-driven volatility has driven the gold and silver crosses to unfactored extremes. But when we compare the leveraged, smoke and mirrors, COMEX-centric, bearishly skewed, undeliverable paper market settlements, so-called settlements, to what we're evidencing in the physically black gold and silver Shanghai physical settlements, they uncover an underlying move by central banks, sovereigns, and institutional actors to convert the short-term overvalued stronger dollar and US treasuries into gold and silver. Now, foreign central banks have slashed their holdings of treasuries, and they're at their lowest level since 2012. Fed published data verifies that the value of treasuries held in custody at the New York Fed by official institutions has dropped by 82 billion to 2.7 trillion over the last 12 months. Now, these US Treasury sell-offs ramped up over the last month and are forecast to significantly accelerate as soon as the Iran war volatility fully subsides, which, although we've seen some subsidence there, it's still pretty volatile. Now, because gold and silver trade as a currency cross against the dollar, when you buy one side of the cross, it sells the other. So when everyone piled into the petrodollar to balance off a war-driven spike in oil prices, under this plain vanilla bearish skew, it created opportunities for central banks to de-dollarize at a more favorable rate, net of what the Wall Street cheerleaders were spouting. That's what was actually happening, not what they were talking about, what they were missing this entire physical move. And as this conversation, or as it would be more accurate to describe, this alchemizing of to physical paper to physical process was, as it was rolling out, due to the automated inverse unallocated FX gold selling against the rising dollar provided the synthetically driven downside momentum, which then bearishly influenced the LBMA gold benchmark fixes lower, but it's patently clear to all physical facing liquidity providers that this paper to physical dislocation has been coiling gold for a very large upside gap close, catch up rally, basically, which was in place before this volatility. Now, with no speculators on board, this rally will have sustainable legs to exceed previous highs, easily exceed previous highs, and in much quicker than most people think. And as we touched on last time, a growing number of mainstream media analysts were leaning into the narrative that gold had lost its safe haven appeal, but these assessments failed to see beyond the mechanical structural relationship between derivative gold and derivative real rates pitched against physical bullion. They just don't have that visibility. And yet, under their blinkered assessments, they're very soon going to backpedal. When they see gold will go out rising, they won't know why. And they're going to backpedal and then, as if, well, we were never bearish gold. But it's because they failed to understand that first-tier gold has been performing as the only alternate asset class that able to provide the necessary instant liquidity when all other asset classes failed. Gold has performed exactly as it should do into a black swan event. And as we assessed last time, initially the gold price overshoot was caused by the plunge protection team disruptively leaning into the plain vanilla mechanical sell-off, which in turn was what generated this myopic mainstream media, their failed safe haven narrative. And whereas in the in the global picture, it was the West's focus on derivative gold that has actually been effectively challenged. Now, under the covers, global South nations stepped up converting overpriced dollars into underpriced physical gold. And as we will illustrate in the chart footprints, which we're going to look at now, they provide absolute evidence that unfactored physical buying has significantly undermined the bearish mechanical correlations that the mainstream media analysts have extrapolated into the bearish safe haven gold narrative. Here's absolute proof they got it wrong. Now, this is gold on the futures charts. Now, following the March 23rd spike bottom, with WTI topping out at 101.67, so inversely topping out into this sell-off, and gold inversely spiking into this low at 4,100, however, illustrating the mechanical dislocations ahead of last night's extreme deadline playing out, driven 100% by underlying physical gold demand, gold had settled the PPTs, the plunge protection team's BIS squaring level, $681 higher, right here, which is where the BIS settled. Now, what gave away that the gold was acting as the ultimate safe haven was ahead of last night's deadline, which is in this area right here. This is a 4-hour chart. So this is ahead of the last night's resolution, basically ceasefire announcement. WTI traded at a high of $117.63. Yet, spot gold versus the petrodollar continued to average a $680 higher price than the initial race for dollars. And we saw that for the whole, this is the end of the month, of the last month of March, and this is where it was coiling. Although it went through a little bit, it was coiling at this level. At worst case scenario, this was the mid-range it was coiling, $680 higher. So then the race for the dollars into this March 23rd, 4,100 low. Now that is 16% higher oil price versus a 16% higher gold price. So a complete inverse, an upside down inverse situation. Now, a clear structural dislocation, which was 100% driven by central bank sovereigns selling dollars and US treasuries to buy gold from the established brand new price floor. And this was indeed the higher price floor. In fact, we think it's now settling at around this level here. Now, looking at the spot charts, not the futures charts, this is where the BIS squared. Now, bearing in mind that the BIS squaring had consistently had to be squared higher and higher and higher. So in this case, it was lower. And this is undoubtedly related to the PPT efforts to contain gold. Now, while these BIS efforts, squaring efforts, settled higher than was likely planned, liquidity providers assessed a combination of short covering and reports leased gold was being bought back at higher prices. And following the race to sell gold to meet dollar shortages, gold and silver are more widely viewed as back in the safe haven camp. We are evidencing many institutionals unshaken from that view.
During the interview, AndrewMaguire dismisses the popular narrative that central banks are turning bearish on gold. He explains that only small amounts of gold were temporarily leased, such as by Turkey, to meet short-term dollar shortages, and these positions must eventually be repurchased, likely at higher prices. He emphasizes that most of the recent price drop was driven by synthetic paper market activity rather than actual physical selling. Meanwhile, major players like China and oil-rich nations used the strong dollar to accumulate large amounts of undervalued gold and silver, accelerating de-dollarization. Concurrently, Maguire further points out that institutions like the People's Bank of China continue to buy gold even during price dips, reinforcing a strong underlying floor. In his view, this steady physical accumulation ensures that any leased or paper-driven supply will have to be bought back at higher, physically supported prices. Let's jump into the interview.
Everyone's bearish gold, so let's say why it is. Let's come up with some sort of idea. And it varies on the day, but that was the one, the main narrative. Oh, yes, central banks are selling their gold now, as if that's the end of things. Well, while we've confirmed reports of a few tons, and we mentioned them last time, of leased gold being lent into the market to meet initial dollar funding shortages. And that was, we showed that Turkey, we put a link up where Turkey had done it. And these leases ultimately, but these leases, all of them, they have to be bought back. And with competing central banks now underpinning the market, these derivative gold loans will have to be bought back at higher physically driven prices. Now, these lease positions generate derivative gold supply, which feeds into the crosses, whereas net, very little, if any, real physical gold or silver has actually been put on sale into this entire 24% synthetically driven gold price correction. It was a scramble for dollars, but it was done primarily by leasing and swapping. However, conversely, and the reason these bets will have to be paid back at higher prices is the stronger dollar has been incentivizing competing global central banks and sovereign entities who already had adequate sold dollar reserves. They weren't racing for dollars. They had lots of dollar reserves, which was like China and the Arab oil-producing nations. And it enabled them to secure hundreds of tons of undervalued gold and silver ounces for inflated dollars, locking in gold while greatly benefiting from their ongoing de-dollarizing gold conversions. Now, as also affirmed in this FT article, while gold was the immediate hedge to raise dollars quickly, that trade quickly reversed. Safe haven gold is being replenished by selling dollars and US treasuries. Notwithstanding that China officially converted a rising dollar into purchasing another 5 tons of gold, as reported here in a Bloomberg article, noting the PBOC purchased gold into the derivative gold dip, and they noted, quote, China's central bank bought the most gold in more than a year in March, demonstrating that a key pillar of support for the precious metals remains intact as prices come under pressure amid the Iran war. Also, it's largely forgotten that in 2023, and we did a lot of exposure on this at the time, former US Treasury official Brad Setzer had assessed that China holds roughly 3 trillion in hidden shadow reserves, which are essentially foreign currency assets stashed outside the official central bank, outside their books. And this opacity and the underlying firepower is aggregated within the PBOC state banks and state-held funds. It's also missed that it's these same state-held banks where the conservatively estimated plus or minus 40,000 tons, I'd say minimum 40,000 tons of PBOC shadow gold holdings are salted. And where are they valued at? They're valued in dollars. And as of February, and they're valued in dollars until the day China wishes to flick that switch. So obviously that's something which would maybe shoot them in the foot right now, but it's a power card they hold. And as of February 2026, which is just really a month and a half ago, China's official dollar reserves were reported at $3.43 trillion. That places China's total foreign assets, when you include these shadow banking reserves, in excess of 6 trillion, double what is officially reported. Now, while these very large unreported monetary gold purchases have tapped into these hidden shadow banking reserves, by no coincidence stepping up at the $2,000 level when the Shanghai Futures Exchange was officially launched in March of 2024. And as we've assessed during the subsequent 24-month $3,600 rally, and even though we've seen a pullback, nevertheless, because some sucked-in speculative demand was responsible for some COMEX-driven naked long overshoots, underlying these events, very large PBOC monetary gold purchasing consistently raised the floor, hence this series of higher physically driven stair steps. Now, by opening the Shanghai Futures Exchange to a wider public, it constituted part of Beijing's 26-year strategy of openly encouraging citizens to buy gold, and more recently, silver too. And this is based solely on the premise that these investments would appreciate into rising prices. Now, both gold and silver consistently trade at a large premium to local London FX gold or futures related gold. They have kept that promise. The PBOC has kept that promise, where necessary, from time to time, intervening in the CNY USD dollar crosses. Now, add in over 25,000 tons of citizen-held gold, that brings total accessible PBOC gold to at least 65,000 tons. Now, that clearly dwarfs the 8,100 tons of questionably rehypothecated gold reserves. And what we do know is that anything stored in China is physically backed. Now, for what it's worth too, in addition, China's domestic shadow banking, which is the trusts, the loans, and the wealth products of yuan-denominated credit, sit at separately at around about another $7 or $8 trillion. So also debunking misinformation that the sovereigns were selling, Arab nations have built up ample petrodollar reserves and are easily able to flywheel short-term imbalances without selling any gold whatsoever. Quite the reverse. In fact, liquidity providers assess aggregation of large competing safe havens central bank sovereign physical unreported monetary gold demand from Arab nations is at unprecedented highs, taking advantage of this oil price glut. So to sum up, even before the ceasefire agreement, and even if it falls apart again, we have been exposed to a race into dollars.
Previously, the idea of gold reaching $6,000 seemed like a far-off dream. But due to increased central bank buying and global tensions, JP Morgan predicts that gold will reach $6,300 per ounce in 2026. Historically, gold prices have been stable or have even increased steadily. But recent economic changes and geopolitical tensions have made its price more volatile. If central banks are aggressively accumulating physical gold while paper markets suppress prices, are we on the verge of a major revaluation that most investors still fail to see? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.